What if I told you that Wall Street legend Tom Lee, who correctly predicted multiple market rallies, says small-cap stocks could outperform the S&P 500 by over 100%? His claim stands on solid ground, with valuation metrics showing small caps trading at just 10 times earnings while the S&P sits at 17. I'm about to share 3 stocks under $11 with millionaire maker potential. Like hidden gems buried in plain sight, these opportunities include an AI analytics company with government contracts and a medical technology firm that increased revenue by 127%. Most investors overlook these treasures. Which one has analysts projecting a potential 5 times return? Let's find out. Do you ever feel like you're constantly missing out on the next big market opportunity? You're not alone. In times of market uncertainty, most investors instinctively flock to what they consider safe havens, those household name companies that dominate the S&P 500. It's a completely understandable reaction. But this seemingly prudent approach might actually be limiting your wealth building potential in ways you haven't considered. When market volatility increases, investors typically retreat to familiar large cap stocks, the Apples, Microsofts, and Amazons of the world. There's comfort in companies whose products you use daily or logos you instantly recognize. These blue chip stalwarts offer security that's particularly appealing when economic clouds gather. It's like watching a documentary about a familiar city while ignoring the unexplored territories that might hold hidden treasures. This flight to perceived safety creates one of the most overlooked wealth generation opportunities in the market. While everyone crowds into the same handful of mega-cap stocks, an entire universe of smaller companies with tremendous growth potential sits virtually ignored, creating a systematic wealth gap between average investors and those who build substantial portfolios. The psychological barriers preventing most people from exploring small-cap stocks run deep. There's the fear factor. Smaller companies are often mischaracterized as inherently riskier. Then there's the information gap. Financial media obsessively covers major corporations, while smaller companies operate under the radar. Many investors also mistakenly equate price fluctuations with fundamental business risk. What these misconceptions obscure is the small-cap stock's remarkable historical performance during certain market cycles. Since 1926, small-cap stocks have delivered average annual returns of 12.1%, compared to 10.3% for large caps. Compound this difference over decades, and we're talking about potentially life-changing sums. Following the 2008 financial crisis, for example, small caps outperformed large caps by over 30% during the recovery's first 2 years. Currently, we're witnessing a striking valuation disconnect. Small caps trade at approximately 10 times earnings, while the S&P 500 trades at about 17 times forward earnings, a 70% premium for large caps, representing one of the widest gaps in years. This valuation discrepancy represents potential for significant outperformance when markets eventually rebalance. Tom Lee has built his reputation on identifying precisely these types of market inefficiencies. His prediction that small caps could outperform the S&P 500 by over 100% in the coming cycle is backed by compelling valuation metrics. If he's right, this represents a rare opportunity for average investors to position themselves ahead of major institutional money flows. Think about what this could mean for your portfolio. While a 10% annual return might double your money in about 7 years, capturing the kind of outperformance Lee is forecasting could potentially accelerate your wealth-building timeline dramatically. With tens of thousands in potential additional returns at stake, the critical question becomes, what makes Tom Lee different from every other market forecaster making bold claims? You're right to be skeptical. Wall Street is full of analysts who make predictions that rarely pan out. But Tom Lee stands apart from the typical financial commentators. As the head of research at Fundstrat Global Advisors and chief investment officer at Fundstrat Capital, Lee has established himself as one of the most reliable voices in market forecasting. His frequent appearances on CNBC have made him a familiar face to investors, but his track record, not his screen time, deserves your attention. Lee consistently identifies major market shifts before they happen. While most Wall Street analysts remained bearish after the 2024 election, Lee's data-driven approach correctly predicted the market surge that followed. This was the result of methodical analysis that cuts through market noise and emotional reactions. Throughout his career, Lee has made several contrarian calls that proved correct. In 2020, when analysts predicted prolonged market depression following the pandemic crash, Lee forecasted a sharp V-shaped recovery. Markets rebounded dramatically in the months that followed, validating his position. He also recognized Bitcoin's potential early on when traditional financial analysts dismissed cryptocurrency as a passing fad. One client who followed Lee's Bitcoin guidance in 2017 saw their modest investment grow tenfold within 3 years, a testament to the value of his foresight. Lee's evolution from identifying macro trends to pinpointing specific sector opportunities has been remarkable. His methodology emphasizes data over sentiment. While many commentators get caught up in headlines and emotions, Lee's team at Fundstrat prioritizes hard numbers and market signals. This disciplined approach allows him to spot valuation disconnects that others miss, precisely the situation he's identifying now with small-cap stocks. His current thesis connects broader economic indicators to specific factors affecting smaller companies. He analyzes metrics like relative valuation ratios, earnings growth trajectories, and liquidity flows, concrete data points suggesting institutional money will eventually recognize the value proposition in this space. Lee believes we're in a rare window where individual investors can position themselves before institutional money creates a rush into these undervalued assets. The dramatic valuation disparity is unsustainable, a market inefficiency that will eventually correct itself. Beyond small caps generally, he's identified key areas like regional banks, financials, and certain technology niches where the disconnect between intrinsic value and current price is most pronounced. These companies have real business models, revenue streams, and growth potential. They're just priced at significant discounts to larger counterparts. Based on his analysis, Lee has identified several specific small-cap stocks trading under $11 with exceptional growth potential, businesses with strong fundamentals, operating in expanding sectors, and trading at compelling valuation. The first company on Lee's radar might surprise you. It's not a household name, but it's already working with one of the most demanding clients on Earth. What if you could invest in an AI company that's partnered with the Department of Defense for a fraction of what you'd pay for NVIDIA or Microsoft shares? Meet BigBear.ai, a company that's quietly building sophisticated AI-driven analytics systems while flying under most investors' radar. This Columbia, Maryland-based firm specializes in decision intelligence and predictive analytics solutions that help both government agencies and commercial enterprises make better, faster decisions in complex environments. While tech giants like NVIDIA and Microsoft trade at $1,000 plus and $400 per share, respectively, BigBear.ai trades at just under $11, making it accessible for average investors seeking AI exposure without committing thousands of dollars. BigBear.ai demonstrates real business momentum, with revenue increasing by 22.1% year over year to $41.5 million in the third quarter of 2024. This represents concrete growth happening right now, not speculative future potential. The company's contract backlog currently stands at approximately $437 million, In an industry where many small-cap companies struggle with unstable revenue streams, BigBear.ai has nearly $500 million in future revenue already secured. This provides remarkable stability that few companies of this size possess. BigBear.ai's competitive advantage comes from their Conductor OS platform, a comprehensive system battle-tested in extraordinarily demanding environments. The company recently demonstrated this technology in a live environment at the U.S. Department of Defense, showcasing its ability to process massive data volumes and deliver actionable intelligence in real time. Regarding profitability, BigBear.ai reported a net loss of $12.2 million in its most recent quarter. However, this figure stems largely from accounting changes and one-time expenses, rather than fundamental business model issues. These temporary factors should resolve as the company continues scaling operations with its substantial backlog. Professional analysts maintain a strong buy rating on BigBear.ai with an average price target of $4.75, representing significant upside potential. More optimistic analysts have set targets as high as $9.78, which would deliver a 5 times return on investment. Like a sleeping giant, BigBear.ai has remained largely unnoticed while establishing critical partnerships and building technology that meets the exacting standards of defense applications, potentially positioning it for substantial growth when the market fully recognizes its capabilities. Of course, risks exist as the company operates in a competitive field and must convert its impressive backlog into consistent profitability. But for investors willing to accept some uncertainty in exchange for early access to an emerging AI player with government validation, BigBear.ai offers a compelling opportunity at its current price point. While government validation provides BigBear.ai with stability, another under-the-radar company is tackling a multi-billion-dollar problem hiding in plain sight. The American prison system costs taxpayers over $80 billion annually, with each incarcerated individual costing around $40,000 per year to house. The staggering inefficiency has created an unexpected investment opportunity that few retail investors have noticed. Enter SuperCom, a global provider of electronic monitoring solutions that's transforming how we approach criminal justice. Their technology offers an alternative to traditional incarceration that's more humane and dramatically more cost-effective. SuperCom's monitoring solutions cost approximately $7 to $10 per day, representing savings of over 90% compared to imprisonment. Their technology functions as a digital guardian, a cost-cutting watchdog that maintains security while eliminating the massive overhead of physical incarceration. SuperCom is capitalizing on this market inefficiency with remarkable results. Their latest quarterly results show a 51% year-over-year revenue increase and an astonishing 2,350% improvement in EBITDA. This rapid growth demonstrates both increasing adoption by corrections departments and SuperCom's ability to translate revenue expansion into substantial profits, a crucial inflection point that typically precedes significant share price appreciation in small-cap stocks. For risk-conscious investors, SuperCom offers a compelling stability factor. 73% of their income comes from recurring revenue through ongoing contracts rather than one-time sales. This provides predictability rarely seen in small-cap investments, creating a foundation for sustainable growth. With over 3 decades of industry experience since 1988, SuperCom has served more than 100,000 individuals across upwards of 50 government contracts spanning multiple countries. This extensive track record demonstrates both technical expertise and the ability to navigate complex government procurement processes, a significant competitive advantage. The company's pure security electronic monitoring suite includes GPS tracking, home detention monitoring, and smartphone-based supervision tools. These technologies maintain public safety while reducing the financial burden of mass incarceration. Early data indicates these approaches can also help lower recidivism rate by enabling offenders to maintain employment and family connections. Government contracts provide investment security, unusual for a company at this price point. Unlike consumer-focused startups, SuperCom's partnerships typically involve multi-year agreements with reliable payment schedules, significantly reducing execution risk. The global electronic monitoring sector is projected to reach $2.3 billion, with North America representing the largest share. SuperCom is strategically positioned to capture significant portions of this market as jurisdictions seek budget-friendly alternatives to traditional incarceration. Analyzing SuperCom's current market capitalization relative to its growth rate, improving profitability, and total addressable market reveals potential for 5 to 10 times returns. The company trades at a significant discount to both historical valuation and industry peers, creating a valuation gap that could close rapidly as more investors recognize the opportunity. What if there was a way to treat skin cancer without surgery, and a small company had already developed the FDA-approved technology to do it? While monitoring solutions are transforming corrections, another revolution is happening in the medical field that most investors haven't yet discovered. Census Healthcare has created technology that's changing how we approach one of medicine's most common and dreaded procedures. Imagine the anxiety of hearing, "You need surgery for skin cancer." The cutting, the scarring, the recovery time. Now picture a patient walking into a clinic and receiving a gentle, painless treatment that feels no more invasive than having an X-ray taken. This is the reality Census Healthcare offers with their superficial radiation therapy, SRT, providing a completely non-invasive alternative for treating skin cancer and keloids. The market's recognition of this breakthrough is evident in Census Healthcare's financial transformation. Their most recent quarter showed revenue of $8.8 million, a 127% increase from last year, while simultaneously improving gross profit margins to 59.3% from 51%. The company has executed a remarkable pivot from a $1.5 million loss to a $1.2 million profit, 7 cents per share, in just 12 months, a transformation that signals genuine innovation finding its market. For patients, SRT represents a sunrise after the dark night of a cancer diagnosis, offering effective treatment without the trauma of surgery. For medical practitioners, it provides a powerful new option that maintains clinical efficacy while eliminating many complications of traditional treatments. Regarding risks, Census Healthcare currently derives a significant portion of revenue from a single customer. While this creates some vulnerability, it also highlights the massive growth runway ahead as the company expands its customer base across more healthcare providers. Each new medical practice adopting this technology represents potential steady, recurring revenue. The market potential is substantial. Skin cancer remains the most common cancer in the United States, with over 5 million cases diagnosed annually. Traditional surgical approaches cost billions, while causing unnecessary suffering. Each dermatologist or oncologist who adopts SRT technology represents a new channel for Census Healthcare's growth. What strengthens this investment case is that Census Healthcare addresses a genuine medical need rather than offering a marginal improvement. Their SRT system has completed the FDA approval process and demonstrated clinical efficacy comparable to surgical without the invasive aspects patients fear. The company's current share price appears disconnected from its growth trajectory, improving margins, and addressable market. The transition to profitability marks a fundamental inflection point that typically precedes substantial appreciation in small-cap stocks. As Census Healthcare gains recognition, institutional investors may take notice, potentially driving valuation multiples higher. So what can we learn from Tom Lee's small-cap forecast? It's about recognizing opportunity in market inefficiency before Wall Street catches up. These three companies represent that principle in action. Remember that investing in smaller companies requires a different approach. Start small, think big, but always plan your risk wisely. Consider building positions gradually, around 2 to 3% of your portfolio in each company, to manage risk while capturing upside potential. The investment journey requires calculated risk-taking in areas others overlook, like finding hidden treasures. BigBear.ai, SuperCom, and Census Healthcare represent companies with real products, growing revenues, and expanding markets, potentially changing your financial destiny.